The stock market just hit another all-time high yesterday. Your financial advisor sent you a cheerful email about portfolio performance last week. CNBC analysts are debating whether we are in for a soft landing or no landing at all. But while everyone is celebrating and popping champagne bottles on Wall Street, there is a massive financial iceberg hiding just beneath the surface of this calm water. And it is not coming from where you think it is coming from at all. The number that should terrify every investor, every business owner, and every person with a bank account in America is not the national debt. It is not the credit card default rate. It is certainly not the price of oil or gold today. It is $929 billion. This is the exact amount of commercial real estate debt that is maturing right now and slamming into a brick wall with no way out. We are living through the early stages of the largest wealth destruction event in a generation. And the mainstream financial media is not saying a single word about it to protect their advertisers. Wall Street does not want you to know about this crisis because they are deeply exposed to it themselves. The big banks hold trillions in commercial mortgage-backed securities that are quietly rotting from the inside out like a diseased tree. The pension funds managing your retirement money are stuffed full of office building loans that will never be repaid in full. The insurance companies backing your policies have bet heavily on the commercial real estate market staying stable forever. They were all catastrophically wrong, and now the bill is coming due with interest compounding daily. This is not a sudden crash like we saw in 2008 when Lehman Brothers collapsed on a Monday morning. This is a slow-motion implosion happening behind closed boardroom doors where executives are praying for a miracle. It is a silent crisis spreading through the veins of the regional banking system like a poison that nobody wants to acknowledge publicly. And if you think this does not affect you personally because you do not own a single office building anywhere, you need to understand something critical right now. Your local community bank is drowning in these loans using the deposits you trusted them with for safekeeping. Before we dive deep into the mathematics of this disaster and the specific steps you must take immediately to protect your wealth and family, make sure you are subscribed to this channel right now. Hit that notification bell so you do not miss the critical updates as this crisis unfolds in real time over the coming months. Comment below and tell me what city you are watching from, because I want to see how widespread this community has become. We are tracking the collapse that the financial establishment is desperately trying to keep hidden from public view. To understand why $929 billion is a ticking time bomb, you first need to understand how commercial real estate financing actually works in the real world. These loans are nothing like the 30-year fixed-rate mortgage you have on your home where you make the same payment every month until it is paid off completely. Commercial real estate operates on an entirely different and far more dangerous model that most people have never heard about before today. When a developer wants to build or buy an office tower, a shopping mall, or a hotel complex, they go to a bank for financing like anyone else would. But the bank does not give them a 30-year loan with predictable monthly payments stretching into the future safely. Instead, they give them a 5-year or 10-year loan with a massive balloon payment waiting at the end like a financial landmine. For the first few years of the loan, the developer only pays the interest portion of the debt each month. This keeps their monthly carrying costs artificially low and makes the deal look profitable on paper to investors. But when the loan term expires after 5 or 10 years, something dramatic happens that changes everything overnight. The entire principal amount becomes due immediately in one giant lump sum payment that can be $50 or $100 million. Obviously, no developer actually has that kind of cash sitting in a bank account earning interest waiting to be deployed. They never plan to pay it back with their own money in the first place because that was never the game. In a normal functioning economy with stable interest rates and healthy demand, the developer simply refinances the loan easily. They walk into another bank, get a brand new loan at similar terms, and use that fresh money to pay off the old loan coming due today. This process is called refinancing, and it is the absolute lifeblood of the entire commercial real estate industry, keeping it alive. The system works perfectly as long as two critical conditions remain true and stable going forward. First, interest rates must stay roughly the same or go lower over time to make refinancing attractive. Second, the building must maintain its value or increase in value so the bank feels comfortable lending against it again. For over a decade after the 2008 financial crisis, both of these conditions were not just met, but exceeded beyond anyone's wildest expectations at the time. Interest rates sat near zero for years, and property values climbed steadily upward in every major city across America without exception. Developers borrowed billions and billions of dollars at 3% and 4% interest rates to construct glass towers in every downtown skyline imaginable. They assumed this era of cheap money would continue forever into the future without any disruption or change. They built their entire financial models on the assumption that refinancing would always be easy and painless and automatic. They were disastrously wrong on both counts, and now the consequences are arriving at their doorstep with foreclosure notices. The loans that are maturing right now in 2024 and into 2025 were originated in the golden years of 2014, 2015, 2016, and 2019 when everything seemed perfect and risk-free to everyone involved. Back then, a developer could lock in a commercial mortgage at 3% or 4% interest and sleep soundly at night knowing their costs were manageable. But today, if that same developer walks into a bank to refinance that exact same building, the interest rate they are quoted is 8% or higher, depending on the property type and location. Think about what this means mathematically for a moment and let it sink in fully. The interest payment on their debt has literally doubled overnight through no fault of their own management or decision-making. If they were paying $3 million a year in interest before, they are now facing a $6 million annual interest bill starting immediately. That extra $3 million has to come from somewhere, and it cannot come from thin air or wishful thinking alone. But the nightmare scenario for these landlords and developers is actually far worse than just rising interest rates alone. While the cost of their debt has doubled, the income their buildings generate has collapsed completely at the same time. We are living through a fundamental and permanent transformation in how human beings work, shop, and interact with physical space every single day. The work-from-home revolution that began during the pandemic was not a temporary trend that would fade away once things returned to normal, as everyone predicted confidently. It was a permanent seismic shift in the fabric of the American economy and workplace culture forever. Office vacancy rates in major metropolitan areas like San Francisco, Seattle, and Chicago are sitting at historic highs right now. In some downtown business districts, nearly 1 out of every 3 office windows is completely dark tonight because nobody's working inside those buildings anymore at all. These are not just vacant suites waiting for new tenants to move in next month with fresh lease agreements and security deposits. These are structurally obsolete buildings that nobody wants to rent at any price because employees refuse to commute 5 days a week anymore. The hybrid work model has won decisively, and the old model of central business district office towers is dying rapidly before our eyes. When a commercial building has 30% vacancy, it is not just earning slightly less profit than it used to in previous years. It is bleeding cash every single month because the rental income no longer covers the mortgage payment, property taxes, insurance, and basic operating expenses like electricity and security. This creates what financial analysts call a death spiral that accelerates downward with each passing quarter. The building cannot refinance because the income is too low to support the debt at higher interest rates today. The owner cannot sell the building because no buyer wants to catch a falling knife in a declining market right now. And the owner cannot afford to keep making mortgage payments out of their own pocket month after month for years. So they face an impossible choice with no good options available to them whatsoever. They can either declare bankruptcy and walk away from the property entirely, losing every dollar they invested over the years, or they can try to negotiate with the bank to extend the loan for another year and pray desperately that something changes miraculously. Most developers are choosing the second option, and this is where the real danger to the banking system begins quietly and spreads like wildfire. The strategy that Wall Street insiders call extend and pretend has become the dominant survival tactic in commercial real estate right now everywhere. Here is how this dangerous game works and why it makes the crisis exponentially worse for everyone involved. When a loan comes due and the borrower cannot refinance at the new higher rates today, the bank faces a terrible decision internally. They can foreclose on the building immediately, take ownership of the property, and record the loss on their financial statements for regulators and investors to see clearly. But recording that loss is absolutely devastating for a regional bank that is already teetering on the edge financially. If they take back a building that was valued at $100 million on their books, but is now only worth $50 million in today's market conditions, they must write off $50 million of assets instantly overnight. For many community and regional banks, a loss of that magnitude would wipe out their entire capital cushion in a single transaction and make them technically insolvent under federal banking regulations immediately. When a bank becomes insolvent, the FDIC steps in on a Friday afternoon, seizes control of the institution, and shuts the doors permanently over the weekend. The executives lose their jobs, the shareholders lose their equity investment, and the community loses a trusted lender that has been there for decades. So instead of facing this terrifying reality head-on with courage and transparency, the banks are choosing to play a game of chicken with economic gravity itself by extending these bad loans. They allow the delinquent borrower to extend the maturity date by another 12 months or 24 months without any new money down. They continue to pretend on their accounting books that the building is still worth the original appraised value from 2019, even though everyone knows that is a complete fiction at this point in time. They pray with every fiber of their being that interest rates will magically crash back down to 3% before the extension period expires and forces a reckoning. But this extend and pretend strategy does not actually solve anything fundamentally wrong with the underlying economics. It simply delays the inevitable day of reckoning and makes the ultimate losses much larger when reality finally arrives. It is like a person with a serious illness who refuses to see a doctor because they are afraid of the diagnosis and treatment plan. The disease continues spreading silently through their body while they pretend everything is fine to their family and friends on social media. The maturity wall we are facing in 2024 was just the opening act of this financial horror movie we are all living through. There's another $957 billion of commercial real estate debt maturing in 2025, right behind this wave, like a second tsunami approaching the coastline. And then another massive wave coming in 2026 and 2027 that is even larger than the previous ones combined together. The extend and pretend game can only last for so long before the banks run out of room to maneuver and hide the losses from investors. The truly terrifying aspect of this crisis is where these loans are actually being held right now in the financial system. They are not sitting on the balance sheets of JP Morgan Chase or Bank of America, who can absorb massive losses without blinking an eye. Those giant banks learned their lesson in 2008 and have been very cautious about commercial real estate exposure since then wisely. The loans are concentrated in regional and community banks that have assets between $10 billion and $100 billion typically. These are the banks that power Main Street America and provide loans to small businesses, local developers, and families in your town. They hold nearly 70% of all commercial real estate debt in the United States economy right now, according to Federal Reserve data. They are loaded to the absolute maximum with loans on strip malls, medical office buildings, suburban office parks, and small apartment complexes in secondary markets. And as these loans hit the maturity wall one after another, these banks are being forced to stop lending entirely to preserve capital. This brings us to the hidden credit crunch that is already strangling small businesses across America without making a single headline. Because regional banks are terrified about their commercial real estate exposure and potential losses, they have effectively stopped making new loans to anyone for anything at all. Try walking into your local community bank today and asking for a loan to expand your small business or buy new equipment for your operations. You will find that the loan officer is extremely polite and professional in the meeting. They will take your application and review your financial statements carefully and thoroughly. They will nod their heads and tell you that your business looks strong and healthy on paper. But at the end of the process, the answer will almost certainly be no with the apologetic smile. They cannot lend to you right now because they need every single dollar of liquidity to cover the tsunami of commercial real estate losses that are coming in the next 24 months for certain. This credit freeze is sucking the oxygen out of the real economy at the worst possible time for entrepreneurs and job creators. Small businesses that need working capital to meet payroll or purchase inventory are being turned away repeatedly. Manufacturers who want to invest in new machinery to increase production capacity cannot get financing approved anywhere. Real estate developers who have perfectly viable projects with strong demand cannot break ground because the construction loans are simply not available at any interest rate today. This is how a commercial real estate crisis metastasizes into a full-blown economic recession that touches every industry and every worker. The banks become zombie institutions that exist on paper, but do not actually function as lenders anymore to the economy. They are merely warehouses, storing bad debt on their balance sheets, while they wait for a government bailout or a miraculous recovery that is simply not coming to save them from insolvency. But the regional banking crisis is only one layer of this financial disaster that is unfolding in slow motion before our eyes. There is an even more dangerous time bomb hiding in the shadow banking system that almost nobody is paying attention to right now. Not all commercial real estate debt is held by traditional FDIC-insured banks that you can walk into and open a checking account at on Main Street. A massive portion of this debt is held by private debt funds, insurance companies, and non-traded real estate investment trusts operating completely outside the traditional banking system entirely. These shadow lenders do not have access to the Federal Reserve's emergency lending facilities when a liquidity crisis hits their balance sheets hard. When they run out of cash to meet redemptions, they cannot just call up the Fed and borrow billions overnight to stay afloat like JP Morgan can easily. They have to liquidate assets immediately by selling them into a market that has absolutely zero buyers at any reasonable price today. Blackstone's Bright Fund was the canary in the coal mine for this shadow banking crisis that erupted last year dramatically. When investors tried to pull their money out of the fund en masse, Blackstone had to limit withdrawals immediately to stop a run on the fund that would have collapsed it entirely overnight. They simply could not sell the commercial properties fast enough to generate the cash needed to pay back panicked investors who were rushing for the exits simultaneously. This gating of withdrawals destroyed the fundamental illusion that real estate is a liquid investment that you can exit whenever you want to get your money back. It exposed the dirty secret that the entire non-traded REIT industry has been built on a foundation of lies and misleading marketing materials for decades. These funds promised investors that they could get their money back within 30 or 60 days if needed for an emergency or opportunity elsewhere. But when everyone tries to redeem at the same time during a crisis, the fund freezes like a deer in headlights and locks the door behind you. Your money is trapped inside a sinking ship, and there's absolutely nothing you can do about it, except watch your account value decline month after month on your statements. But the most systemically dangerous aspect of this commercial real estate collapse involves commercial mortgage-backed securities, or CMBS for short. These are the complex financial instruments that Wall Street created to package thousands of individual loans into a single tradable bond that investors can buy and sell easily. Pension funds, insurance companies, and retirement accounts across America bought trillions of dollars of these CMBS bonds over the last decade for their supposedly safe and stable yield that provided steady income. The sales pitch was incredibly appealing to conservative institutional investors managing other people's retirement money carefully. You get a bond that pays 5% or 6% interest annually, backed by a diversified pool of office buildings and shopping centers across multiple states and cities. The rating agencies like Moody's and S&P gave these bonds AA or 8AA ratings, indicating they were as safe as U.S. Treasury bonds themselves, with virtually no default risk whatsoever. But the loans inside these bond packages are now rotting from the inside out as vacancy rates climb and defaults spike rapidly. When a loan in the CMBS pool defaults, the bond immediately stops paying interest to the investors who own it in their portfolios. Suddenly, the safe and conservative portion of your retirement account is taking massive losses that nobody warned you about in advance at all. The yield you were counting on to fund your retirement lifestyle has evaporated into thin air without a trace. The delinquency rate on office CMBS loans has spiked to levels we have not seen since 2012, during the depths of the European debt crisis. And we are still in the early innings of this crisis, with years of pain ahead before it bottoms out completely. The rating agencies are scrambling to downgrade these bonds now, but they are already far too late to provide any useful warning to investors who needed it months or years ago. This is the exact same pattern we saw in 2008 with subprime mortgage bonds that carried AA ratings until the day they collapsed overnight. The rating agencies are paid by the issuers of the bonds, not by the investors who buy them, creating a massive conflict of interest that leads to inflated ratings and systematic deception across the entire market structure. They have a financial incentive to give high ratings to garbage debt because that is what their clients want them to do for marketing purposes. The entire ecosystem of commercial real estate finance is built on a foundation of confidence, leverage, and the assumption that property values only go up over time naturally. When confidence evaporates because of visible cracks in the system, the leverage turns into a wrecking ball that destroys equity holders in seconds flat. We are watching this wrecking ball swing through different sectors of the commercial real estate market methodically right now in real time. The office sector was the first to crack under the weight of work-from-home trends that are permanent and irreversible forever. But now the contagion is spreading to sectors that investors thought were completely safe from these secular changes happening. Medical office buildings were considered the safest investment in all of commercial real estate for decades, because doctors and dentists always pay their rent on time without fail historically. But the operators of these medical facilities are being crushed by rising labor costs due to nurse shortages and inflation in healthcare expenses. They cannot afford to pay the higher rents that landlords are demanding after interest rates doubled their debt service costs. So they are breaking leases, vacating buildings, and consolidating their operations into fewer locations to survive the economic pressure squeezing their margins. This adds another massive layer of toxicity to bank balance sheets that nobody forecasted or modeled in their stress test scenarios. It proves beyond any doubt that there is no safe haven anywhere within the commercial real estate market during this crisis period. Even the sectors that were supposed to be recession-proof and stable are cracking under the weight of higher interest rates and changing economic fundamentals. The multifamily apartment sector, which was the darling investment of the last decade for institutional investors, is now showing serious signs of stress and weakness as well. In Sunbelt cities like Austin, Phoenix, Nashville, and Tampa, developers built way too many luxury apartment complexes over the last 5 years chasing yield. They assumed that the migration trends from expensive coastal cities would continue forever and fill their units immediately at premium rents without any vacancy concerns. But the migration wave has slowed dramatically, as remote work allows people to live anywhere they want now. New supply is flooding these markets faster than demand can absorb it, causing rental prices to fall month after month in a downward spiral. Meanwhile, the debt payments on these massive apartment complexes are rising because many developers used floating rate loans that adjust with interest rates automatically every quarter without any cap or protection. His creates negative leverage where the property is actually destroying wealth every single month instead of creating it for the owners and investors. The syndicators who raised money from doctors, dentists, and small business owners to invest in these deals are now sending emergency emails to their investor base, asking for more capital immediately. They are making what are called capital calls, demanding that investors send additional cash to save the property from foreclosure and total loss. But most investors do not have extra cash sitting around waiting to be deployed into a failing investment that is already underwater. They refuse to throw good money after bad, and the property inevitably goes back to the lender, adding yet another distressed asset to the growing pile on bank balance sheets that nobody wants to own or manage right now. The sheer volume of distress is completely overwhelming the foreclosure court systems in states like Texas and Florida, where the apartment boom was concentrated heavily. Courts are backed up for 6 months or longer, creating a legal purgatory where zombie properties sit in limbo, deteriorating physically every single day. An empty building is a dying building in commercial real estate because maintenance stops and decay accelerates rapidly. Pipes burst during winter. Mold grows in humid climates. Copper wiring gets stripped by thieves, and vandals break windows for fun, destroying value. By the time the bank finally gets legal title to the property after months of court delays, the asset is worth even less than when the foreclosure process started originally. This physical decay compounds the financial decay in a vicious cycle that accelerates losses beyond what anyone modeled in their worst-case scenarios. So how do you protect yourself and your family, as wealth, as this silent crash gains momentum and spreads throughout the financial system? You must start by fundamentally understanding that your bank is not a safe vault protecting your money in a concrete bunker somewhere secure. Your bank is a highly leveraged hedge fund that takes your deposits and bets them on illiquid long-term loans like commercial real estate mortgages that cannot be sold quickly. When those bets go catastrophically wrong, your supposedly safe deposits are suddenly at risk of disappearing overnight in a bank failure. The FDIC insurance protects individual accounts up to $250,000, but that protection is meaningless if the entire banking system enters a systemic crisis simultaneously. The FDIC insurance fund only has about $125 billion in reserves right now to cover failures. But there are over $10 trillion in total bank deposits across America today. If even 2% of banks fail, the insurance fund is completely exhausted and cannot pay claims anymore without a taxpayer bailout. So your first defensive move right now today is to diversify your banking relationships immediately across multiple institutions carefully. Do not keep more than the FDIC insured limit of $250,000 in any single bank, no matter how safe and stable they appear on the surface. Spread your cash across multiple banks and prioritize the systemically important institutions that the government has implicitly guaranteed to rescue no matter what happens. It is deeply unfair that the big banks like JP Morgan are safer than your local community bank, but that is the corrupt reality we live in today. Second, if you own or operate a business of any size, you must secure lines of credit immediately before you actually need them for operations. Do not wait until you have a cash flow crisis to ask your bank for emergency funding, because the answer will be an automatic no during a credit crunch. Banks are cutting credit lines without warning right now to preserve their capital ratios and avoid regulatory scrutiny from examiners. Draw down the credit you have access to today and park that cash in a separate high-yield savings account earning interest as an insurance policy. Cash on hand is the ultimate weapon during a liquidity crisis because it gives you options and flexibility when everyone else is desperate and panicking. Third, you need to look very carefully at the commercial real estate dynamics in your specific local market and city right now. Real estate is hyperlocal, and the contagion spreads at different speeds in different markets depending on local economic conditions. If you live in a city with high office vacancy rates above 20%, you should expect dramatically higher property taxes on your home in the next 12 to 24 months guaranteed. City governments will be forced to raise residential property taxes to fill the massive budget holes created by declining commercial property tax revenue from empty buildings. They will also increase fees on everything from water and trash collection to building permits and parking tickets to generate revenue. Be prepared for this fiscal squeeze on your monthly household budget because it will eat into your disposable income significantly. Fourth, avoid investing in any illiquid real estate funds or private syndications that lock up your capital for years at a time without redemption rights. Non-traded RATs and private real estate funds are death traps right now because you cannot exit when you need your money back urgently. You can only get out when the fund manager decides to let you out, and they are freezing redemptions to prevent runs on their funds. Stick to liquid investments that you can convert to cash within 24 hours, like treasury bills, money market funds, or publicly traded stocks and bonds. Illiquidity kills investors during a maturity wall crisis because you are trapped inside a burning building with no exit doors available to escape. But there is also an offensive strategy for sophisticated investors who have patience and dry powder to deploy when the time is right. This commercial real estate crash will create once-in-a-generation buying opportunities for those who wait for true capitulation and blood in the streets. Distressed properties will eventually sell for 30 or 40 cents on the dollar, resetting valuations to levels we have not seen since the 1990s or early 2000s. but you must have extreme discipline and patience to avoid catching a falling knife before it hits the ground and stops moving. Do not try to buy properties in 2024 or early 2025 thinking you're getting a deal at 30% off peak prices. Wait for the full capitulation phase where banks are forced to liquidate assets at any price just to clear their balance sheets and survive. That phase has not started yet because we are still in the extend and pretend stage of this crisis cycle. Keep your powder dry and watch the special servicing data from commercial mortgage servicers closely for signs that the dam has finally broken completely. When foreclosure auctions begin happening every single week in your city, that is the signal to start seriously looking for opportunities. The $929 billion maturity wall is not just a crisis to fear and hide from in your basement. It is also a massive wealth transfer event from the unprepared to the prepared. Investors who understand the cycle, debt is being destroyed on a historic scale right now, and that destruction creates opportunities for those with cash and courage to act decisively. The silent crash that Wall Street refuses to warn you about is getting louder every single day. As more buildings go dark and more banks tighten lending standards, the cracks in the foundation are spreading rapidly, and the entire structure is becoming unstable and dangerous. You have been warned with specific data and actionable strategies to protect yourself and potentially profit from the chaos ahead. Make sure you're subscribed to this channel and have notifications turned on, because we will be tracking every bank failure, every major foreclosure, and every policy change as this crisis unfolds in real time. Share this video with anyone who owns a business or has significant money in regional banks because they desperately need this information right now. We are navigating this storm together, one data point at a time, and information is your most valuable asset in the battle ahead. Stay safe, stay liquid, and watch the wall closely because it is coming down faster than anyone on Wall Street is willing to admit publicly.